Is the real estate market finally cooling off? Find out right now. Hey, if you're a homeowner, investor, or interested in buying property here in South Louisiana, we have all the data you need. Hi, I'm Ethan Broussard with Keaty Real Estate, and this is your market update. Once again, we are off to another record-breaking year. So far, Lafayette has experienced a 13% increase in sales year over year. That's 81 more sales than in 2021, with February 2022 reporting an 8% increase year over year with 351 sales, breaking the record set last February. As you can see in this next chart, when looking at February sales going all the way back to 2012, Lafayette Parish reported a significantly more sales in February of 22 than any other February in the last decade, showing signs that demand is still climbing. Now this trend continues into total dollar volume sold. Lafayette Parish reported a 24% increase, breaking over $188 million in dollar volume. That's an additional $36 million in volume sold year over year. So last week we talked about sales and volume, but this week we are diving into supply and demand. Lafayette Parish reported 11% fewer new listings February of 22 versus February of 21. However, the MLS reported a 24% decrease in total actives available. So what I am seeing is slightly less new listings coming onto the market compared to last year. But the demand is absorbing the inventory faster than homes are becoming available, and that is leading to a lack of supply. So the demand is driving the lack of inventory, not necessarily lack of sellers listing their property. Because of this lack of supply in the last 12 months, our days on market has decreased from 58 days to 29 days. This is an indication of a seller's market. Buyers are competing for less homes. Here's another very interesting trend. The average showing to pending ratio going back to 2014 was 5.5%, meaning it took on average 16 showings to sell a house. Our inventory declined in 2020. You can see the showing to pending ratio increased significantly to 16%, meaning it only took 6 showings to get a house sold. That is a 60% increase in the showing to pending ratio year over year. So, real estate prices are a function of supply and demand, and months of inventory is how we can keep a pulse on what is happening with our supply and demand. Looking at our inventory going back to 2012, you can see we have hovered around 5 and 6 months of inventory, which is considered a balanced market. Starting in 2020, we have experienced well below average inventory levels and have reported inventory levels to be under 5 months of inventory. This lack of inventory has created a seller's market, and the average price in February of 22 has increased from $246,000 to $269,000. That's a 9% increase year over year. So, where are we going? I'm glad you asked. Going back to 2012, we have experienced moderate appreciation of 3%. This is well below the national average of 4.14%, so I do not believe we are in a bubble. Actually, with the impact of inflation, the experts believe that prices will most likely continue to rise over the next few years and beyond. As an example, if we continue to experience appreciation at 3% over the next 20 years, our average price will be at $485,000. But if we follow the national average appreciation, in 2044, our average price will be over $600,000. Let's take a look at this next graph from the Home Price Expectation Survey. I think it gives you a very good picture as to where home prices will be according to the experts. So what are they looking at? The most optimistic experts say we could see a 62.5% appreciation by 2026. The pessimist, 23.7%. And we average all of that out and we get 43.3% appreciation by 2026. So as you can see, all signs point to prices continuing to rise in the long term. Homeownership is really a hedge against inflation because, as you can see in this next slide, over the past 5 decades, home prices have increased faster than inflation. That means someone buying a home today can lock in today's cost, protect themselves against the rising cost of inflation, and lock in that monthly payment going forward. So it becomes mission critical for renters to understand this dynamic of buying now. Renters take on additional risks by waiting to buy. Most experts are forecasting higher interest rates, higher home values, And if you look at the rental market going back to 1988, rent has only continued to increase with no signs of slowing down. So at the end of the day, waiting to buy will cost much more money. Lafayette Parish has experienced a 1.3% increase in pending sales in February year over year. So it looks like although we had a record-breaking January in closings and volume, the pendings seem to have cooled off, meaning we should expect the same or slightly fewer closings in the next 30 to 60 days compared to last year. However, when you were looking at the numbers of pendings for February going back to 2012, you can see we are well above the average number of pendings for the month of February, indicating we should expect an outstanding first quarter. And although pendings have cooled, demand continues to hold strong. In fact, the MLS reported that over 19% of homes sold in February were above list price. This is double the average over the last decade, indicating a very strong demand for housing and a short supply of homes for sale. And as always, we like to keep an eye on what is happening with interest rates. Now, in order to predict where the interest rates will go, you have to look at the 10-year Treasury yield. Although the Fed does not directly control interest rates, they do control the 10-year Treasury yield. Now, by raising or lowering the Treasury yield, they hope to influence the interest rates. In other words, the Treasury yield and interest rates have a symbiotic relationship. When the Treasury yield goes up, so do the interest rates. You can see in this chart that the 10-year Treasury yield has skyrocketed in the last 3 months, from 1.43 in December 1st of 2021 to 1.81 now. So you can expect interest rates to follow. In this chart, you can really see the relationship between the mortgage rates and the 10-year Treasury yield over the last 50 years going back to the 70s. Over the last 5 decades, the average spread between the 10-year yield and the interest rates is around 1.7. We also look to the experts. We average the predictions of Freddie Mac, Fannie Mae, and the Mortgage Broker Association and the National Association of Realtors to come up with what to expect moving forward. As you can see, we expect the rates to increase to above 4% in the fourth quarter of 22. Is this bad? Sometimes we need some perspective. Looking back at the last 5 decades, you can see there has never been a better time to buy than now. But we do expect interest rates to rise. I hope you found this information valuable. If you'd like to receive these monthly market updates, or if you'd like a free market analysis on your property, I'd love to help. Stay tuned for next week when I will break down March's sales and volume. I'm Ethan Broussard with Keaty Real Estate. Thanks for watching.